Hi, you're watching ET Markets Live. I'm Neha Vashisht Mahajan. Welcome to a brand new episode of ET Smart Investors, where we talk about your investments and much more. Today, I'm here with Mr. Chirag Muni. He is the Executive Director at Anand Rathi Wealth Limited. Thank you so much, Chirag, for joining us today on ET Markets Live.
Thank you, Neha, for inviting me.
Well, the pleasure is all mine. In today's session, we are going to talk all about a mutual fund fact sheet. Let's start with the basics first. What exactly is a mutual fund fact sheet, Chirag, and why is it considered such a critical tool for investors?
So, Neha, firstly, I want to congratulate you. You're taking such very good topics. I think very basic in nature, but I think very
Hmm.
important for most investors. Often so many of such things we kind of ignore. Coming back to your question, what is a fact sheet? I think it's a simple, concise document that, AMFI and SEBI has kind of mandated all the fund houses to give the
Hmm.
information of various things of a scheme. What is the scheme? What are the objectives of a scheme? Who's the fund manager? What are the portfolio
Hmm.
holdings? So it gives you in a simple one-page document which they are mandated to report every end of every month,
Hmm.
and so that the investors can look at all these basic information and then make a more relevant and informed choice.
All right. Let's also try to understand how a fact sheet works and how does the SEBI mandate and AMFI guidelines ensure that there is a standard maintained when it comes to fact sheets across different mutual fund houses?
So absolutely, I think SEBI has kind of created a framework because and AMFI of course,
Hmm.
because obviously in the past mutual fund houses used to report their fact sheets in a very different formats,
Hmm.
but they have mandated them to have specific format so that investors can look at that format and then
Hmm.
they can compare easily. So they've standardized a lot of disclosures. Number one, they've also mentioned that some of the ratios, which are risk ratios like the beta, standard deviation,
Hmm.
and now of course the information ratio has to be part of the fact sheet.
Hmm.
Other basic information is what is the objective of the scheme, what is the AUM, what is the expense ratio, all of that in a very simple, concise way that they're mandated to, so that when investors look at fact sheets of different fund houses, there are close to about 700 open-ended schemes now, and of course, so many other
Hmm.
schemes on the equity side itself. So, how does a mutual fund investor compare? So, if he has the same format, he's looking at all these schemes together, then they'll be able to evaluate that what is the beta of this scheme, what is the beta of this scheme, so on and so forth. So, all of that on one page is what they've
Hmm.
mandated in a very standardized format. So no fund house can have their own formats. They're barring a few information here and there, but all the
Hmm.
basic information has to be there in the same format. You'll always see the name first. You'll always see the scheme. What is the objective of the scheme. Then you will see what is who's the fund manager, what is the performance. All of that comes in the same format for all the fund houses, so that it's very easy for an investor to compare.
All right. So before we get to what all is covered in a fact sheet, let's also try to understand how does a fact sheet, help in understanding various things that actually matter to investors?
Yes, so the most important thing is, you will know where your money is invested because, it gives you information of what the scheme is all about, what are the portfolio
Hmm.
holdings, where I've invested. Because often we know, a lot of times we make decisions just by looking at performance. You
Hmm.
would have looked at some of the websites where you see that the fund is performing well and you just invest. But end of the day, you also need to know the basic information of where you have invested. What is the risk that you are taking? So is it suitable to your objective? Because you would
Hmm.
have obviously as a layman it's very difficult to understand whether I'm investing whatever scheme I'm investing, is suitable to my objective. If I wanted to be
Yeah.
slightly safe in equity, then am I investing only in a large cap fund, or is it also has mid caps and small caps? So all of that a
Hmm.
fund house will able to say. It will give you how consistent is the fund, because it will give you the fund performance, the track record.
Hmm.
So all these information will then be able to help you to assess it rightly.
All right. So, for anyone who is going to refer a fact sheet for the first time, what all does a fact sheet cover basically? What are the different information out there that is important for an investor to, look at?
So some of the basic information which is their right to know is only which scheme they have invested. Number one, then they will
Hmm.
also it will be mentioned what is immediately it will be mentioned what is the objective of the scheme. So whether the scheme is here for capital appreciation, for income generation,
Hmm.
or having a balanced approach, so that you're very clear as to where you're investing. So you clearly the objective will be mentioned. Then what type of fund it is, whether it is equity, whether it's debt, whether it's hybrid, because many a times we just see the scheme and invest because somebody has advised you.
Hmm.
But is it only equity, is it only debt, is it balanced? All of that will be
Hmm.
clearly mentioned on the fact sheet, so that you're very clearly aware where you're invested. Then of course other basic information of what is the name of the scheme, who's the fund manager, what is his name, what is his experience.
Hmm.
Is he more experienced, less experienced? So you will get clear when was the scheme started.
Hmm.
Sometimes you would think that the fund has fund house is in existence for a long time. So
Yeah.
you are investing in a new fund, assuming that this fund is in existence, but the scheme is actually new. So you clearly know that how long the fund has been. Then what is the assets and the management they are kind of managing currently? Is it very less, is it more? So you're very clear about what is the average AUM. Then what is the expense ratio? So
Hmm.
how much fee or management fee you're giving for the to the fund manager to invest into this fund, to manage this fund. Then what are the entry and exit loads? Because often we are not aware of is there any entry load. Now there is no entry load, but there are exit loads at point of time, that especially in equity, that if you exit within 1 year, then it is 1% of the portfolio that you will have to give as an exit load. So all of that will be clearly mentioned on the fact sheet. Other than that, of course, the return details, what has been the 1 year, 3 year, 5 year returns, what is the
Hmm.
SIP returns if you're investing in the form of SIP, so that you're very clear as to what kind of course, past performance is not a reflection of a future returns, but at least you'll get a sense of how this fund has been performing over a period of time,
Hmm.
how long this has been in existence, basis which you can then again take a right choice. And then, of course, you
Hmm.
also get the portfolio holdings of where it has
Okay.
been invested. So all of that is being covered in a fact sheet.
All right. So, can you elaborate a little bit more when it comes to portfolio holding details and what kind of details are typically disclosed in a fund fact sheet, and how should investors, try to read them out?
So, firstly, it clearly mentioned the asset allocation in the sense how much is invested in equity, how much in debt,
Mm,
how much is there
mm,
lying in cash. So that when you're aware of what is the asset allocation of a scheme, basis which
mm,
then you can decide on the asset allocation of your overall portfolio. Because if some scheme you have more of debt, then you know that this
mm.
portion of it should be counted as part of my debt portfolio. So you can
Right.
clearly decide on the asset allocation. Then of course it will also clearly tell you what is the market cap allocation, how much is large cap, how much is mid cap, how much is small cap. If I had a certain objective of what should be my market cap allocation on my portfolio, then each
Mm,
scheme has a different market cap allocation. So then you'll have to
mm,
look at overall market cap allocation, how much it is. So that will help you to kind of assess that how much am I towards large cap, how much am I towards mid cap, how much am I towards the small cap. Again, this is my objective. Then I can take a decision. Then of course it will also give you sector allocation, that
mm,
how much is invested in financials, how much is invested in auto, how much is invested in, if it's a diversified fund, of course. So all of that will clearly tell you what is my sector exposure. Then it will also tell you which are my top 10 holdings, how much is my weightage in each of the stocks that the fund manager
mm.
is investing. So this is clear on the portfolio side. These are the 4 or 5 things that will be clearly shown to you, which will help you to then make a decision.
All right. So, let's also talk about some risk measures that the fact sheet covers. We recently, in our last live stream session, we spoke about information ratio. So, what are the different ratios or risk measures that are mentioned in the fact sheet that could be helpful for an investor?
So far till 31st March, three important ratios were mandatory, which is the standard deviation, the beta, and the Sharpe ratio. And like you rightly mentioned, we covered information ratio in the last show.
Mm.
So that has been mandated by SEBI from this year onwards. That the information
Mm.
ratio has to be there part of every fact sheet. So if you look at now, the newer
Okay.
fact sheets will also have the information ratio. Now let me take you one by one as to, like you mentioned, the one is the return side, but you also have to look at the
Mm.
risk side, right? How risky is the
Right.
portfolio? So one is standard deviation, means what is the deviation of its returns with respect to its average returns that is being given over a period of time. So a
Mm.
standard higher standard deviation means a higher percentage of standard deviation means it's a more riskier fund. A lower
Mm.
standard
Mm.
deviation means it is more it's lesser risky. So that will give
Mm.
you what kind of volatility you can expect in the fund. Then the second is the beta of the fund, which is nothing but it will give you the sensitivity of the fund with respect to its benchmark. So if the
Mm.
benchmark, let's say, is Nifty, how much is the Nifty volatile with respect to how much is a fund volatile? So it will give you the sensitivity, not the exact second decimal, but it will tell you how much volatile it can be.
Mm.
Beta, so for example, beta of 1 means it is equal to the risk of the benchmark. If the beta
Right.
is
Right.
more than 1, which means it is slightly more volatile than the benchmark. If it beta is
Mm.
lesser than 1, then it is less volatile than the benchmark itself. So that will give you a clear indication. Then, of course, Sharpe ratio, which is again very important parameter, which is called the risk adjusted return.
Mm.
The simple formula of a Sharpe ratio is what has been the fund performance so far, what is the returns, minus the risk-free rate, which is the Government of India rate, divided by the volatility, which is the standard deviation of the portfolio or of the fund. So
Mm.
why it is negating, I mean, slightly technical, why it is negating the risk-free rate? Because that's your
Mm.
opportunity cost. If you can't, if you don't do anything, you can easily invest into 6.5% into a Government of India bond. The fund manager is not doing anything there, right? So if a
Yeah.
fund is giving you 6.5, then it doesn't make sense to invest. But anything
Mm.
more than
Mm.
6.5 is which will tell you that's the excess return you are getting, and divided by the risk of the portfolio. So per unit of risk, how much return you are getting, that will be the
Mm.
Sharpe ratio. And then information ratio, of course, we covered. Again, it is instead of the risk-free rate, it compares it to the benchmark returns divided by the tracking error. So that will clearly tell you, compared to the benchmark, how much more risk it is given to give the excess return. So these are the four important parameters of risk that an investor should look at in the fact sheet. Higher the information ratio, better it is. Higher the Sharpe ratio, better it is.
All right. So, since we've spoken about risk measures, let's also talk about risk-adjusted return because ultimately an investor wants to understand what will be the tentative return they'll be getting from a mutual fund. So, how does a fact sheet help in understanding the risk-adjusted return?
So, like I was saying, Neha, the most important ratio there to look at is the Sharpe ratio, because that
Mm.
gives you the risk-adjusted return. Higher the Sharpe ratio, better is the risk-adjusted return. Lower the
Mm.
Sharpe ratio, lesser is the risk-adjusted return. So
Mm.
that from an applicability point of view, that's very easy for a client to just look at that number. From a
Mm.
just if I have to give you a very simple example, that let's say if both two funds are giving the same returns, right?
Mm.
So let's say fund A is giving you 15 and fund B is also giving you 15. The
Mm.
risk-free rate is common for both, which is 6.5%. But the standard deviation of, let's say, fund A is 8%, and the standard
Mm.
deviation of fund B is, let's say, 10%, which means fund B
Mm.
is taking a higher risk. So the
Yeah.
it will have a lower Sharpe ratio, and your fund A will have a higher Sharpe ratio, which means it is taking lesser risk to give you 15, and fund B is taking more risk to give you 15. So I
Mm.
should choose fund A versus fund B. That's how you should look at
Yeah.
the risk adjusted return of a portfolio. Similarly, when you're looking at in the same category, if I have, let's say, HDFC Flexi Cap, and if I have another Kotak Flexi Cap, for example, how can I compare the both on the risk adjusted basis? If the Sharpe ratio of HDFC Flexi Cap is higher than the Sharpe ratio of Kotak Flexi Cap, that means HDFC Flexi Cap is more better in terms of a risk adjusted. That's how we have to look at it.
All right. let's before closing our session, let's also try to understand about overlapping. So a lot of people end up investing in similar kind of mutual funds or funds that have overlapping there. So how can a fact sheet help investors avoid overlapping investments, and especially when they are holding multiple mutual funds?
So absolutely. So because when they look at the fact sheets, like I mentioned, that it will also give you the portfolio holdings, that how much it is invested in each of the sector and each of the funds. So to
Hmm.
avoid that concentration risk, is very important to look at, because normally we don't invest in one scheme. We'll be investing
Hmm.
across schemes, right? So we
Hmm.
need to look at what is the overlapping stocks. For example,
Hmm.
I've invested in Fund A, which also has the same stock, and Fund B also has the same stock, which means there's no use of buying two schemes, because
Yeah.
ultimately they're buying similar stocks, right? So how much is the overlapping,
Hmm.
that will help you to check, or it will also help you to reduce your concentration exposure. And for example, if I have bought an HDFC Flexi Cap fund, and then I'm buying an HDFC banking fund, right? But there is
Hmm.
a possibility that HDFC Flexi Cap itself has a 30-35% exposure to banking and financials. So if I'm adding HDFC banking, which means I'm adding more of banking and financials to my overall portfolio. So do I
Yeah.
want to take that risk or no, is what the fact sheet will help you to assess. So finding out what is the overlap and what is the concentratage, which can help you clearly balance your portfolio and have a more smoother diversification rather than having more concentration, and reduce your risk. So that's how it will help you. Similarly, also when you're having a portfolio, for example, let's say you have a portfolio of only small cap funds, and
Hmm.
haven't looked at the fact sheets, and you have, let's say,
Hmm.
HDFC small cap, you have Invesco and Bandhan small cap as your portfolio. So we just did a study that, let's say on June 4th, which was the election date, the markets were
Hmm.
significantly down. So the small cap index was down 7.5%. If you
Hmm.
had invested in these three funds, your portfolio would be down by about 7%. Similarly, but if you had invested into a small cap fund like HDFC, you're invested in mid cap, and you're invested in
Hmm.
SBI Blue Chip, which is a large cap fund. So you have invested across market caps, then
Yeah.
in the same way your portfolio would have down by 5%. So because you were
Hmm.
diversified within market caps, and you looked at the fact sheet that how my portfolio,
Reducing the risk.
you reduce the risk. So all of that
Hmm.
will help you.
All right. So before we close, any closing remarks for any investor who is watching us right now, why they should uh, make sure they check the fact sheet before investing in a mutual fund?
Absolutely. So the one is before investing, and one is of course after investing as well, consistently looking at the fact sheets, because that will
Hmm.
give you a track record. I think track record is what happens often. We just depend on either our advisors, or we just look at information from a secondary source. Rather, if you have invested, spend some 2-3 minutes end of the month looking at your fact sheets, because
Hmm.
it will clearly lay out that how concentrated I am, what is my market cap allocation, is it suitable to my advice. A lot of the senior citizens sometimes are not aware that they are investing more into equity, because somebody has
Hmm.
advised them. But if they read the fact sheet, they can, by simple 2-3 points, they'll be able to understand that I'm taking more risk maybe. So all of
Yeah.
that, and then it avoid you to overlap these stocks. So all of these things, it can help you to really make a very informed choice, so that you have a more smoother journey of making your investments.
All right. Well, this marks the end of our segment for today. Thank you so much, Chirag, for decoding fact sheets for us and our viewers as well. Thank you so much for joining us today.
Thank you, Neha. Thank you so much.
Thank you, everyone. Thank you, everyone, for joining us today.